How's it going, everybody? My name is Antonio, and I'm here today for some resource talks with Grant Isaac, who, as everyone would know, is the Executive Vice President and CFO of Cameco Corporation, which means that today we'll be focusing on uranium. We'll be talking about contracting cycle, spot market, enrichment, conversion, Cameco's order book, the future of maybe the juniors and their plans for M&A or not, and a lot more. But what we're not going to be doing here today, though, giving you financial or investment advice, given that Grant is an insider to the uranium industry. His opinions are likely to be biased, and you should know that. But this is going to be a conversation that is general and impersonal in nature, and one that will include a lot of forward-looking statements, speculations about future events and stuff like that. And that means that taking investment decisions based on any information provided in this podcast might result in 100% loss of capital. And that also means that you should probably consult a licensed financial advisor before taking your own decisions, carrying your own responsibility in the end. That all said, Mr. Isaac, thank you for investing your time with me, sir.
Yeah, it's great to be here, Antonio. Look forward to our discussion.
I I do as well. I got to tell you, Grant, I'm a little nervous, and English is obviously not my primary language, so I might be stuttering a lot because there's just so much information in your head. I've heard you speak so many times, and I'm still not sure how to extract a good portion of that. But let's maybe start from sort of a broad level. That we're clearly in a uranium bull market. We've been in one for a while now. Yes, you can say 2016, or you can say that the bear market ended in 2016. But this is not your first fiasco. So how are you experiencing this market? How do you feel it in the tips of your fingers? Does it look like any of the previous ones? What's different? What's the same? Talk to me about these things.
Great place to start. There are certainly some features of this cycle that look very familiar. Utilities often leave their run rate requirement contracting for too long. We go through a long complacent period. We don't have replacement rate contracting. We're well below. That has a normally depressive effect on prices as those depressive effects work through investment decisions. The supply side just isn't invested in. When prices of uranium are way below production economics, there's no incentive to invest in the pipeline. Then generally something happens to kind of wake up the need for the term contracting to come back. And we realize that the pipeline hasn't been there, and we start to see contracting that begins to approach replacement rate and then off and above. And that's where there's really strong price formation. So that part feels very familiar. There's nothing really new about that sort of psychological backdrop to how the market works. But there are a few things that are really different. Number one, I think, is this is driven to a large degree by a geopolitical angle that hasn't existed in the past. This has been a market that has been highly globalized. It really didn't matter where your uranium or your fuel fabrication services were coming from. It matters today. Secondly, not only does it matter where it comes from, but there are ESG characteristics of that supply and that service that matter now more than they have before. So that's an interesting backdrop. Thirdly, and probably most importantly, this market doesn't have the normal shock absorbers that it would have on the supply side. So in the past, yes, there hasn't been investments in the primary production stack as a result of low uranium prices, but we've always had that secondary supply to work through, the inventory that was in government hands, the inventories that producers had, the inventories that were held by utilities or maybe in various stages of the fuel cycle. You have a look today, you've got a primary production stack that is lagging the demand outlook, and you've got a secondary supply stack that is also lagging the demand outlook, so that built-in shock absorber is missing. Those are three profoundly different features of this cycle. They all suggest that we're in the early innings of a security of supply contracting cycle, and one where we just think the return to production economics is a rather inevitable conclusion, just because we're not even at replacement rate contracting yet, as evidenced by even recent data from UxC. and we're already in the mid 50s for uranium prices. We've never started from this high of a base before, so pretty exciting times to be an incumbent producer in this market.
You mentioned UXC here, and the way where I know this from, by the way, is the Uranium Insider on Twitter. So shout out to him. He reported, I believe yesterday, or it might have been today, that 116 million pounds of uranium have been contracted under long-term contracts year to date. So this year alone in 2023, not even 6 complete months into the year. That's quite a lot. Historically speaking, and averaged out of the over the rest of the year, this could lead to over 200 million pounds of contracted this year, and so above replacement rate contracting, which I suppose is up for debate, but is around 180 million pounds. And so far, the replacement, what I've been wondering about really here is why is it happening so much at the beginning of the year? So what I mean by that is that usually contracts would be weighted towards Q4, at least from what I know in my brief experience in the industry. So how come we are already seeing that much contracting this year? Does that mean that we're going to see a whole lot more in Q4, or is it weighted in the first part of the year for a different reason?
Yeah, too early to tell. Really, I would think the first half of this year could be characterized as actually momentum carryover. The 2022 year was pretty impactful for the Western side of the Western demand in our market. The Russian invasion of Ukraine, a few months before that, the social unrest in Kazakhstan. There was a lot of things to get folks concerned that needed to procure material on a go-forward basis. So we saw a lot of contracting occur in 2022, and I think the first half of the year has just been the carryover of the activity that started. Whether we can fully annualize the first half of the year remains to be seen. But what I can tell you, and we often give folks a bit of a glimpse in this, we talk about it as a leading indicator. Our pipeline of pounds that we have under negotiation remains very large. Even though we've successfully executed a number of contracts in the last 18 months, we continue to see a lot of demand come our way. So we just see a market that really is in those early innings of a security of supply contracting cycle.
So here's what I would really like to ask you. I'd like to ask you to pull up your crystal ball and just tell me what the price is going to be at the end of the year, but I guess I can't really do that. So let's maybe talk incentive price instead. The main thesis that got me into uranium is called rickroll, but also that was that the price had to go up to incentivize new production, because the price was below the price of production, and producers were actually losing money at that price, which was 2016 at around $18. And otherwise, the lights would go on. But so in the meanwhile, we've climbed a lot, and we've heard that the incentive price is, it was, since I've been in the thesis, 60, 65, 70, $75 a pound. And you've previously alluded at least that it might be close to $90 a pound. So where is that price today? Like what's a reasonable incentive price for uranium today?
So much to unpack in that question. It's a really good one. And let me just start with the supply side of our industry. Because of low prices that persisted for a very long time, needs to catch up. It needs to catch up in terms of an appropriate price signal has to be sent. But in our industry, it's not just a price signal. You also have to build the appropriate homes for that production. It's, a uranium producer has to get two variables right, Antonio. You have to get volume right. You have to bring on production on time, on budget, just like you said you were going to do. And that's no different than any other mining company challenge. But unlike other industries, you have to time it for when the market actually is out looking for your supply. We don't sell to a smelter. We don't sell to a metals exchange. And so what you've got to do is time your successful delivery of a project to match when there's demand in the market looking for it. So that actually creates a challenge which affects the cost curve. So now the cost curve has to be adjusted by, we're going to need more Western supply, of course, but we're going to need more Western supply in this bifurcated market at a time when utilities are looking for it, which is going to suggest it needs to be sooner. And so we're just going to see the contracting pick up as the demand picks up and we hit replacement rate and go above. We tend to see really strong price formation. And that should restore that production economic pricing, which, arguably we wouldn't quarrel with the folks that say it needs to start with a 7, needs to be in the 8s with the supply chain challenges, the inflation challenges. Good news for us is that's not Cameco's challenge. Cameco does not need to bring on a brand new project. That we don't need anything licensed. We don't need anything permitted. We don't need to commission, build anything new in order to take advantage of this growth. So we see a strong price formation, and our objective is just to be exposed to that through a contracting that commits our volumes into the future, but prices it out into the future. We're not looking to lock in today's prices. So, we just see a much more favorable demand outlook and a much more favorable outlook for where pricing needs to go. And it allows us to be strategically patient and look for that exposure to future higher prices that we need. That is not the same thing as saying spot exposure in the future. The inverse of your question is to ask, well, how is it that we have 116 million pounds of demand in the market in the first half of this year, and yet we're still only sitting, in the mid 50s for a spot market? Why hasn't the spot market responded more quickly? Well, the answer to that question is the inverse of you've got to get your timing right. You've got to get your production lined up for when someone's looking for it. Too often in our industry, and this is really critical for investors to understand, too often in our industry, the supply side creates its own headache. There are producers out there who believe that they should be spot exposed, who believe that they should sell into the spot market. So if you want to know why the spot market has not responded even in the face of all of this term demand, it's because you continue to have some primary producers who do not have a term home for their production, and they look to clear through the spot market. That puts pressure on the spot market. And so what's the lesson to be learned? The lesson to be learned is don't do that again. As you look at a term contracting cycle, don't make the mistake of believing that the uncovered requirements curve, which shows that out to 2030, there's going to be about 100 million pounds of demand. That doesn't mean there's 100 million pounds of demand in 2030. When we're in 2030, the discretionary in-year demand will be 8 million pounds. It'll be 10 million pounds because utilities between now and say 2026, 2027 will contract for what they need in 2030. And so this spot exposure nonsense is what creates this lag effect between the spot price and where the term market is going, because you have this stubborn interest by some producers to sell into the spot market. So all of that has to affect your view on where production economics need to be. We know the price needs to be higher to incent new projects. It's the existing projects that are spot exposed that are a drag on today's price formation.
Right. And it's interesting to me sometimes to see feasibility studies or final investment decisions that show a 15-year or whatever life of mine where the said aspiring producer has assumed a $75 uranium, but they also aspire to sell into the spot market, which would naturally over a given period of time crash that price below the 75. So they're not going to get the economics that they're promising, and they're sort of shooting themselves in the foot, which is kind of contradictory to the whole thesis. So that it's an interesting point. You, though, Cameco, during your last call, said that you will be buying uranium in the spot market, that you will have to be buying, if I'm not mistaken. So have you already been doing that since your last investor call? And do you think you're going to be doing more of that this year?
Yeah. let's just keep going with this theme of how we think about the spot market relative to the term market. The
Sure.
term market is what we're focused on. Utilities actually, in a security of supply contracting cycle, they double down on the term market. They actually have less spot exposure than they normally would in the future because they're in security of supply mode. They're looking to secure their run rate requirements. So this notion that this market is breaking to spot or will have more spot volumes in the future, end use demand as spot volumes, is actually just not true. So the way we look at it is you've got to get volume right. You have to get timing right. To get timing right, you have to be engaged with the term contracting cycle, and you've got to be layering in those volumes. You've got to know what your commitments are. And once you know what your commitments are, you then look to source to meet those commitments. And you can source from production, you can source from inventory, or you can source from purchasing. And your question was about the purchasing piece. We always at Cameco are we're always in a position where we will have to buy material in the spot market in order to meet either in-year sales or say next year sales. We know what our committed sales are. We've never, as a rule, been producing exactly what we need to produce to meet in-year committed sales. Why? Goes back to my earlier point. Because we know that there's folks in this industry who will produce material for the spot market. And they will put downward pressure on the spot market by selling material that doesn't have a home. And that's material that from a long-term perspective will actually show up as cheap material. And we want to be in a position to deploy some demand to pick that up. So we will always look to buy more in the spot market than we sell. We occasionally sell in the spot market, but let's be very clear about that. It's not sales to intermediaries, it's sales to utilities. So imagine we're in a contract negotiation with a utility and they're looking for long-term material, long-term commitments, but they might say to us, and we could use some additional material in the next 12 months. That would show up as a spot sale that Cameco makes, but it's not a spot sale in our minds. It's the beginning of that term contract commitment. And most importantly, it's going to an end user. We're not selling it to someone who's going to churn it back into the market. So for us, we're always looking at those committed sales. We're always looking at sourcing them from production, from inventory, or from purchases. And we just plan our purchases to reflect what's the best value proposition for us at the moment. We don't chase the market. We can be very patient. We look for particular origins. We look for particular locations. We buy it when we need to. We often buy it very quietly. And what we do is we watch what's happening with some of the financial players in the market. And when we think they're going to be in the market buying, and we don't look to compete with them, we play a very long game for sourcing our commitments over a very long time horizon.
So you're almost acting as some sort of a commission, if you will, to the market, where someone's trying to maybe take advantage of short-term spikes in the spot market, and then you're mopping up that extra supply. That's a good way of putting it. It does set you apart as a company too, I think, as opposed to there's people out there being loud about the health of the market and how producers need higher prices. And on the other end, they're selling into the spot market, hurting the whole market. I get that point. You in that investor call that I was referencing, though, I believed you said something around 9 million pounds of uranium that you would need to purchase this year. Is that still the case? Can you give me any number?
Let's dig a bit deeper into the purchases. We could make purchases in year for immediate delivery. We can make purchases out on the curve. So we make a purchase, but we don't take delivery till later. Or we can make really long-term purchases. If we thought uranium was really cheap today, we could buy it. We could act like a utility. If somebody's offering fixed prices really cheap today, we'll take delivery out into the future. And that escalated price might well be below where we think that cost curve needs to be out in the future. And then we like to reserve the right to take that material at any point in time that we want. We call these long-term purchases. So we just have a suite of tools we use. We don't buy everything in the spot market for immediate delivery under our committed sales portfolio. So when I referenced the 9 million pounds, what I was talking about was really that entire basket of purchasing. Remember, our material from Inkai, from Kazakhstan, we're an equity investee in that joint venture. So it shows up as a purchase. That's in that number. Then we have some long-term purchases. Those are in that number. So I think at the time of putting out that disclosure, we had a couple million pounds that we would have needed to buy at some point in 2023. And when we buy that, we buy very opportunistically. We buy it when we see the right origins and we see the right locations. And then, of course, it's subject to where we want our inventory to be. That's a variable. As we sell more volumes, our inventory target goes up. So we need to source more material. And then, of course, it's subject to where our production numbers are running in year as well. So they're a basket of variables, and we just manage them over the long term under the knowledge of what we have committed to sell.
So the amount that you might have to buy this year will vary depending on what's going to happen over the rest of the year. Yeah. Do you think it'll be easy to source that material? I mean, the spot market seems to be getting tighter and tighter. We have financial players popping up monthly now, almost. So
this is a very tight market. It's a very tight market for the reasons that we've talked about. The primary supply stack is not poised to respond to improving prices immediately. And the secondary supplies of all sorts and shapes and forms is just not available the way it's been in the past. So it's increasingly harder to source that material. I mean, we wouldn't be in a mid $50 spot market if it was easy to source the material. But remember, we're not afraid of seeing higher prices in the near term, even if it costs a bit more to buy, because we have market-related references in our contract portfolio. So our contract portfolio is improving with the improving prices. And of course, as I already said, we have a pipeline of negotiations that we're involved in right now. And as the front end prices go up, well, the floors and ceilings in a market-related contract that we're negotiating will be improved. And so the value capture of the committed portfolio and the under negotiation portfolio, and the pounds that we haven't even begun to negotiate yet, the value capture there is always greater than, chasing a few pounds in the front end of the market. So, we understand how this market works. It's the prudent way to take a quick move in a commodity price, but lock it in for rather long-term cash flow and earnings to the benefit of our shareholders, not just play an up and down spot game. There are other commodities where that makes a lot of sense. It doesn't make sense in this commodity because the spot market is so discretionary and, quite frankly, irrelevant to the fundamental demand of utilities.
I hope there's someone listening who's thinking this is really complicated. I should do more research into this market before putting money into it, because it's really different. It's obscure. It trades in a very different way. And 5 minutes of a podcast doesn't really give you enough information of how complicated this is. I've been trying to figure it out for years now. And conversations like these would still help. And I'm still not exactly sure what I'm doing. You say that you talk about the pounds that you haven't even begun to negotiate, and you also mentioned your contract book, and that's an important one for me because if I copied the numbers of your presentation correctly, you have 26.6 million pounds of production capacity. At least that's your share of the mines that you operate or not operate, but are a shareholder in with the JV in Inkai and so on and so forth. So 26.6 million pounds. And if I understand correctly, an average of 26 million pounds per year is already contracted for the next 5 years. Is that correct?
Yeah, it is. But remember that is an average. and it's an average over 5 years. And we've already provided guidance in 2023 that we are going to deliver between 29 and 31 million pounds of uranium this year. So obviously, there's more pounds sold in the first couple of years, less pounds sold in the last couple of years. That's a sliding scale. It's exactly where we want to be. We want to be well covered in year. We want to be well covered the next year, supports all of our investments and growth decisions. But then we want to be exposed to a market that we think needs to discover more production economic pricing. So our contract book is building out exactly the way we want it to be at this stage of the contracting cycle. And so as we layer in those commitments, we prefer right now for those to be market related. So yes, we're committing to sell material out into the future, but we're not looking to price it today. We're looking at market related pricing, which simply means we'll commit, Antonio, to sell 200,000 pounds of uranium to you every year from 2025 to 2030. And what we're negotiating is what's the price reference we use at time of delivery for first delivery in 2025 and then each of the subsequent years. So you have market related exposure. It's not spot exposure. It has a term home. It's production that isn't going to dump into the spot market and push a thinly traded market down because it just shows up with no home. So it's market related, but it has a home, very disciplined way to do it. So that is the lower wedge of our committed sales. The upper wedge is you just, imagine what we can produce, what we haven't layered into committed sales. That's the true exposure of Cameco to rising prices. So that's why I say there are pounds that we've committed to sell. There's pounds that are under negotiation, and there's future pounds we're not even talking to anybody about selling right now because we think there's more evolution in the market, and there's probably a more attractive scenario for them.
It sounds to me like you're really getting the upper hand, though, in these negotiations, and in what you look, because what you're saying here is so positive for Cameco. And I'm wondering, on the other side, is it really security of supply that the utilities are after? Like, are they sort of paying a premium because they know you're a reliable supplier?
Yeah, I would. There's no doubt that there are premiums in the market, for certain origins and certain supply. And the way I know that is because right now the long-term price is really only influenced by fixed prices. Maybe a lot of folks don't know this, but when we sell market-related volumes out in the future, those don't really affect today's term price reporting because I think the trade reporters look at it and they say, well, we don't know what the future price is going to be. So who knows, could be up, could be down, but in any event, it doesn't affect today's price. So what really affects term price reporting today are fixed prices, where someone is willing to fix the price today. So different than the scenario we talked about earlier, if you wanted 200,000 pounds a year, 2025 to 2030, and you wanted a fixed price, well, we're going to fight over two things. One is we're going to fight over what's the starting price. And number two, we're going to fight over how it escalates to first delivery, how it escalates through the delivery window. And we look at today's long-term price, $56. We know we can do better than that. If Cameco were fixing the price today, we'd lose the upside and the leverage, but we know we could do better than starting at 56 escalated. That's an average. So it suggests to me there's still somebody in the market who's willing to sell below that, or willing to sell fixed prices below that for them to be able to average out, a $56 fixed price. But make no mistake, that's a great price and it's moving in the right direction, obviously. But there is more influence of the fixed prices in our market than there are of the market related prices. And it's something that hopefully we can improve as an industry. the trade reporters themselves, the price reporters, have their own price forecasts. And so you would think a market related contract should reference their own view of future prices and help form the long-term price today. If it did, we would actually see stronger long-term prices being posted. But it is a feature of our market. It's one where I like to think of that long-term price today as more of a floor than a ceiling. It's the fixed price that people are willing to sell at, from which you then want to, for us, we'd want to layer in floors and then have market related exposure into the future going forward. We've seen these markets before. We have a pretty good idea how they evolve.
And I'm happy that's the case, because if that would, because those price predictions are usually very conservative, if you will. They're they're on the lower end. People always get sort of angry over them being too low, those price predictions. So if those were the ceilings, that and the market would look different. But that's something, yeah, as you said, the industry can work on.
Remember that price reporting in our business is also, it's a bit backward looking. I mean, the prices that are reported are prices that have already been discovered in the market. They're not suggesting what the next marginal pound should sell for. So oftentimes you got to think of that price signal as being seen in the rear view mirror by the price reporters, as opposed to being, the price that they're seeing through the windshield being what's required to clear the market with the next transaction. So that, combined with a conservative nature, combined with a focus of fixed prices over market related prices, all gives you a sense that when you see a long-term price being posted at $56, for example, the market is sort of drawing a floor in the mid 50s from which market exposure is on top of that.
Right. What happens to you after those 26.6 million pounds? Well, I guess if you ramp it up to full capacity, that'd be 32 million pounds of licensed capacities where you're at right now, your share of production. But what happens at higher prices after that than your current contract? So what do? Do you go to brownfield? How long does that take? And talk to me about that.
Yeah, we just really like the position we're in. We're in a position with a lot of brownfield leverage in order to take advantage of this resumption of demand in our market. So the number you referenced is actually achieved by taking our three tier 1 assets, McArthur River Key Lake, Cigar Lake, as well as our asset in Kazakhstan, JV Inkai, and imagining that the conditions are right to run them at their full capacity. So McArthur at 25 million pounds a year on a 100% basis, Cigar stays at 18, and JV Inkai goes 20% above subsoil use. Now, we're not there right now. The market, the demand in the market does not justify that. We are actually still technically in supply discipline right now. But if we saw the demand come into the market and the price incentive through discovered demand in order to justify those decisions, our tier 1 assets alone, already licensed, already permitted, already built, could go to 32 million pounds a year. The next thing that we would be thinking about after that, if the conditions are right, if the demand is in the market, if we've seen the demand discover the appropriate prices, we would look to our tier 2s. Our tier 2s, 100% owned, a mine in Canada called Rabbit Lake, and then we have assets in the United States, a couple of operations there, 100% owned. If those came back at the levels they were running at in 2016 when they came down, that could add another 6 million pounds of annual production. So we could be around 38 million pounds of annual production. Again, we're not there, but it's all brownfield, already licensed, already permitted. We don't have to build anything in today's inflationary environment, today's supply chain environment. So we really like our position, but at the moment, our position is to remain disciplined, because this market is not yet at replacement rate, as evidenced by we're not yet at production economic pricing. And so it would not be prudent to front run what you think is a demand surge with supply that you're now trying to jam into the market.
How long would it take for you to get to that additional 6 million pounds from your brownfields?
Well, remember here's the other nice thing about a term contract. Think about a spot market in the mining industry. In a spot commodity, spot price goes up for a variety of reasons. Spot price goes up. You're under immediate pressure to start to produce more, to take advantage of that spot price. But of course, if everybody does that, that spot price push is short-lived. But you need to move very quickly. You gotta, whatever it takes to get more production out of the ground. That is not our incentive. Because we build the homes first, and remember, as we build those homes, as we're signing a contract today, we're probably not starting to deliver until 2025 on that contract. So now we have a natural built-in window, runway, to plan those production increases. So by the time we've seen enough demand and enough price formation in the market to call for our tier 2 assets, we'll have had a lot of signaling through our contracting success, and that runway will be in place, and we will have the plans in place in order to deliver on the ramp-up activities. We never find ourselves in a situation where we have to absolutely turn something on to try to capture in-year demand, because as soon as we start selling material into the spot price, that spot price momentum would be lost. That's just the reality.
What I'm really trying to figure out here is how long it takes for comparable projects to come online. Maybe not yours specifically, but other producers too. Like how far would it realistically, how long would it take for other producers, and the companies that I'm probably referencing, for them to bring some additional supply online?
Yeah, we see a lot of, if I think about our backyard here in the Athabasca Basin, or I think about some of the announcements we've seen recently out of Kazakhstan, and I think about those announcements relative to the reality that we see on the ground. I mean, just a reminder that here in northern Saskatchewan, Cameco is the only company that actually mines in northern Saskatchewan, mines for uranium. The type of activity that we would expect to see going on right now in northern Saskatchewan in order to achieve some of the timelines that we hear about is just not happening. So we look at that and we say, based upon all of our experience, based upon the challenges that we know exist in constructing anything in northern Saskatchewan, we've got a lot of brownfield leverage advantage over anything that is a greenfield mine, greenfield mill prospect. So, Tim, our CEO, has said before, a greenfield project in the Athabasca Basin is a 10-year undertaking. He should know he's built all of the last mines in the Athabasca Basin. So with that experience, we look at our portfolio and we say we have an inside advantage, obviously, because we're simply talking about brownfield leverage from things that are already licensed, already permitted, already constructed. We look across at Kazakhstan and we see some of those announcements and we say, but we know the operating reality on the ground is that it's difficult just achieving the current production plans, let alone the plans to get back to the subsoil use production levels nationally, let alone go beyond that with existing assets, let alone build greenfield. So, no surprise, when the market is exciting, everybody wants to promote a project. But you have to separate the messages that are marketing messages from truly mining information, truly accurate estimates of how long it actually takes to develop mining projects. And we do see a disconnect between those.
Right. Do you ever expect open pit mines to become a thing if we actually need a lot of uranium in Canada and in the Athabasca Basin to speed up that process?
Perhaps it looks like there are some projects that are closer to surface that might be amenable to some form of open pit mine. I mean, that's what Key Lake used to be. That's what Rabbit Lake used to be. There is a history of open pit mines in northern Saskatchewan, but the higher grade deposits were found a bit lower and not amenable to open pit. Whether we return to that will be interesting to see. You're seeing other methodologies being explored in the Athabasca Basin that have not been utilized before, like in situ recovery, for example, and a lot of work going on there. Our view is that there are more conventional methods which are probably more reliable, more predictable, better time frames, at least until there's further technological developments, which we'll watch very closely. But at the moment, we think those higher grade opportunities are really underground, and that's just going to drive the need for denominator. I mean, uranium is no different than any other mine. At the end of the day, you need denominator in that resource base, and then you need price to turn a resource base into a reserve. Mm-hmm. And then you need to deliver a very complicated project in a remote location with a difficult regulatory environment and extreme weather conditions. So you got to deliver that, and that production needs to show up when the timing is right in the market. If you show up with all of that production, and we've had a demand surge go through the market, and we're back into, below replacement rate demand in the market, then that's going to be a repeat of some of the projects that we saw coming off the 06-07 window. I mean, that was the Kazatomprom experience, looking at high spot prices, building productive capacity, building it without a home, showing up with all this production and having to jam it through the spot market. And we saw some other projects and some other companies actually not be capable of withstanding the downward pressure that they were creating on the price. And those assets are now in the hands of state-owned enterprises. So We've seen markets before. You got to get these projects right from a volume point of view. You got to get them right from a timing point of view. And that's not easy. Anybody who tells you it's easy is someone who's never done it before.
It's also not an open pit is not a magic solution. Like, imagine we wake up, 6 months in the future, and there's all these open pit deposits over there. What you said that Tim has said that it takes 10 years to put a greenfields into production. That's after final investment decisions has been taken and all these things, and regulatory process has been done. But from having a thesis to actually having a mine, it's a very lengthy process. That could easily double the time from what I'm heard. So it's not like all these pounds will be dumped on the market immediately.
That is true. I certainly don't disagree with the notion that many of the projects are not going to achieve the schedule that's being promoted at the moment. But we do have to understand that the very promotion of those schedules does create its own overhang on the market. So we spend a lot of time with fuel buyers. We spend a lot of time at industry conferences. And unlike other markets where sort of the user of that mineral doesn't pay attention to the exploration and advanced exploration sector, in our industry, fuel buyers do. And so they do hear these time frames, and they do believe that maybe that supply is coming, and so maybe they don't have to worry about the future as much. And so for any one project, it probably makes sense to hyper promote it. But the effect of hyper promoting all projects is it creates a complacency in future demand that we think is unwise, but it just delays the kind of demand coming into the market today, because some folks will say, well, I'll just wait for these other projects to come along because, look, here's a feasibility study and it looks really good.
Mm.
So it's a weird problem in our industry where for any one project, there's a lot of incentive to hyper promote it. But the negative effect of hyper promoting everything is that it actually delays the kind of price restoration to production economics that everybody wants on the production side. So that's why I said earlier, it's actually the supply side that has created its own challenges in the past by bringing on supply when it hasn't been appropriately timed for the market.
Very good point. It was a CEO actually of a company who told me this, but the mining industry generally in the exploration side of the story specifically punishes over promising a lot less than it does under promotion. What that means is that you can over promote and be late on schedule. Your share price is still going to be higher than it would have been if you didn't promote at all. So it's not going to punish you as much for under delivering as it's going to punish you for not promoting it enough. And so I can see where the incentive comes for promotional companies to do that. But as you're describing, it's important to think about it in long-term views, I guess. So
yeah, there again, if I were in that position, I might be tempted to do the same thing. I just am not in that position. And so I do think there's a lot of truth to the notion that over promising is rewarded. And I've been around these cycles long enough to know that oftentimes the folks who did the over promising aren't around when the reckoning comes anyway.
yeah.
So it's not like there's, a personal connection to that over promise. And we've seen that time and time again on the uranium side. So look, I don't want to be creating the impression, though, that I'm not super excited about the opportunity in uranium mining. I think it's fantastic. And I think it's probably as strong as it's ever been. I just think that there's a lot of there's a temptation to oversell the ability of the supply side to react to this great demand outlook. And I guess at 30,000 feet, I don't understand why that would be a temptation by some, because ultimately restoring production economics is to the benefit of anybody who has a project on the uranium side.
Which is a real project and would work, which is an important asterisk. But in all fairness, we do need a well-financed junior market to make these discoveries, just because of how hard it is really to make economic discoveries. And so we need a lot of guys out there trying.
I couldn't agree more. If you look at some of the projects in the Athabasca Basin, they would not have been probably discovered and worked up to PFS levels by a major, because a major would have spread an exploration budget and a corporate development budget much thinner. But the idea that you have an integrated target and a capital market there to support it and a very motivated team, well, that's fantastic. It's fantastic for the future pipeline of uranium. That is an incredibly important role for the fuel cycle. But finding a resource in the ground is a necessary but not a sufficient condition to capturing long-term value in the uranium space. Just because you found a resource means you're now at the start line and you've got a very, very long path to go to turn that into durable cash flow and earnings. And don't even take my word for it. Just go back to the last big price spike. Look at how many uranium companies there were back then, and look at how many there were in the lows of the uranium price evolution. So that's not a resilient strategy.
I totally agree. No, I absolutely agree. Brent, we haven't been talking much about overfeeding, and I know it's a complete switch of focus here, but I do want to get that through. I guess started easily. Is there really an overfeeding issue right now in 2023?
One of the really exciting developments in 2022 was people realizing that the nuclear fuel cycle is more than just uranium. You don't produce uranium oxide and back a dump truck up to a reactor and dump the oxide in. You have the uranium oxide, and now it begins a very long journey to become a bespoke fabricated fuel bundle. And for 90% of the reactors around the planet, that fuel cycle involves an enrichment stage. So you've got to take natural uranium and you've got to bring up the level of the U-235 isotope. So as folks are starting to understand the fuel cycle more, they're starting to understand how critical it is for a company to actually be across the nuclear fuel cycle because of the value creation opportunities. I mean, in the early stages of a security of supply contracting cycle, you wouldn't want to just be a uranium producer, because then you're left watching the services being contracted, and you're waiting for just the pure uranium demand to come into the market. So we like being across the fuel cycle, and we like seeing the evolution of demand because it starts downstream and it works upstream. So the enrichment pace is just absolutely critical because there's such a strong trade-off between enrichment and uranium. An enrichment plant that is running at existing capacity, has a very tight relationship with uranium. But you run an enrichment plant at lower than designed capacity, it can actually create uranium in the form of underfeeding. And where does that end up? That ends up in the uranium and conversion market, and it is just excess supply. But an enrichment plant running at overcapacity actually consumes more uranium, so it actually is net demand to be added to what the utilities are looking for example, or what strategic inventory builds are looking for. Right now, the key to more overfeeding is more UF6 supply. Right. So no surprise, you're seeing our Port Hope plant increase production, you're seeing the French plant increase production, and you're seeing the restart of the conversion plant in the United States. All because conversion prices have gone up, because folks are looking for this UF6 service, because you need uranium oxide turned into a gas to show up in an enrichment plant. And as we can sort of debottleneck that part, we probably will see a move to more overfeeding, which is just yet net more demand for the same UF6. So it is a pretty exciting adder to the demand story.
But so we have a conversion shortage right now where we're turning the U3O8 into gas form UF6, and then you're gonna put it into the enrichment facilities to enrich it to higher values of U235. Trying to sound smart, and it's not looking good for me. But so is that a bottleneck for uranium prices too? Because I think the question sort of explains itself. Is it a bottleneck for uranium prices to go up, the fact that we're currently having these issues?
Shortage is an interesting term in the conversion space. I mean, conversion price has gone up just because there's more demand chasing a fixed amount of supply, obviously. But UF6 can be found if you're willing to pay a lot more for it than a few years ago. And so no one's going without, but prices have gone up just to reflect that there's more concern over that segment than there has been in the past. The bottleneck is really how the UF6 integrates with the enrichment complex. You still need the product at the end of the day. If you had more overfeeding, you would need more product, and the product is uranium, and there's no substitute for it. Conversion, enrichment, and fabrication are just services that get applied to that product. So it's not so much that conversion is holding back more uranium demand in absolute terms. It's that as utilities work from fabrication through enrichment, through conversion back to uranium, they're really focused on enrichment and conversion right now. And that's a little bit to the expense of their demand for uranium. But you saw from the numbers you talked about, that is returning. We're getting towards replacement rate contracting, perhaps even pushing above on the uranium side.
Well, Cameco also runs conversion too, right?
We do, yeah. So we're involved in obviously mining and milling. We're involved in refining uranium. We're involved in converting it for both the heavy water fleet in Canada as well as some other countries, and also converting it into UF6 gas required for enrichment. We're not involved in enrichment, although we have an ambition in that area. And then, of course, fabrication. We are in the fabrication business on the light water side. And when the Westinghouse transaction closes, we will be involved through, as an equity investee in Westinghouse, through light water fabrication for a significant part of the global fleet. So we are in conversion. That's an important part of our business for sure.
Well, just in between, by the way, I'm going to go and continue on conversion. When do you think the transaction is closing?
Our hope at the time of the announcement in October was that it was going to be about 12 months to close. We continue to be working on that path. It's just, it's a lot of work goes into approving a transaction in a controlled technology area like nuclear, in a world where energy policy is really front and center for a lot of policymakers and a lot of regulators. So we're not surprised by any of the questions that have come. We've got approvals in a bunch of important markets. We have a few more that we're working on, but still tracking to that 12-month hope that we put out in October of last year.
Okay, thank you. It was just an in-between question. I was wondering about it earlier. How much of your conversion capacity is booked over the next couple of years?
Conversion's the same as uranium from the perspective that you build the homes for the service, and then you call for more production. What you don't want to do is be selling conversion into a spot market. There historically hasn't really been a spot market of conversion. So for us, we are building additional homes for that conversion. It's going hand in glove with uranium sales because a lot of utilities are looking for UF6 as a product, not just uranium, not just the conversion service, but UF6, which is the uranium and the conversion together. So the improvement in the uranium contracting is mirrored in the contracting on the conversion side. So again, what we like to do is we like to see the kind of moves that happen in the nuclear fuel cycle, and then we want to lock in that value for long-term cash flow and earnings. And then whatever caused that tightness in the market, when that abates, we've captured that value for a longer period of time. So in the conversion market, we will see the resumption of facilities that have been idled because prices were so terribly low. And when that happens, more supply comes to the market, prices in conversion over time could moderate. We'll have captured that value for a long tail of cash flow and earnings, even after prices could moderate as more supply comes on.
So am I to understand this as plans to increase conversion capacity in the future are present?
When you take a macro view of the Western need for conversion, there are Western conversion facilities that if all of them were running, they could meet Western demand or very, very close to meeting Western demand. They're idled because the conversion price got so low, it made no sense to run a couple of the facilities. So 2 were running, 2 were shut down. Now 3 will be running, 1 is shut down. But if all were running, then Western demand will roughly be matched by Western supply. So we're not really interested in seeing additional supply come on that we would invest in. We have to look at the market and say it'll probably be balanced out in that window. We just want right now, while there is a need for the conversion in the market, we want to be providing solutions to the customers that are looking for that conversion.
Good point. So it's really a business decision. I like it. I like the approach. Well, what about enrichment? You have an investment related to it. Well, I mean, I guess we can talk about that too. I saw some speculations out there that you might be looking to finance Silex GLE facility so that they can start operations earlier. Is there merit to that speculation?
Yeah, I can only give you our perspective on it. So it's an exciting third generation enrichment technology using lasers to enrich uranium gas in order to achieve the levels of normal commercial SWU, perhaps all the way up to kind of the high assay, low enriched uranium that's required for some of the advanced nuclear reactors. And along the way, that technology has been chosen by the Department of Energy in the United States to re-enrich depleted UF6. So UF6 that's already sitting in canisters. It doesn't have the natural amount of 235 in it. It's below. That material would need to be re-enriched to be able to sell it as natural UF6. So GLE has a number of different things it can do, which is pretty exciting. And it represents a technology diversification for the industry, and it represents a supplier diversification for the industry. And both of those are pretty important. But it is a technology development project. And our goal is to get it to sort of technology readiness level 6, which think about that as the technology works, it enriches, but at TRL 6, you can demonstrate it enriches to that nuclear reliability level, that 6 sigma level of reliability. And that's the moment where you would want to start to move towards a final investment decision based upon some revised CapEx and OpEx numbers. So we're still working through that process. The speed at which that process occurs will really govern when you're going to have a project up and running. This is the nuclear industry. We're nuclear realists. It does take longer to bring nuclear assets online. They don't just pop up overnight like we were talking about from the mining perspective. Same goes for enrichment. And along the way, the incumbent enrichers will be, I'm sure, looking to kind of protect their position in the market through their forward contracting as well. So all of that needs to be baked into the cake as we advance the technology. We're super excited about it. But, our view is everything would have to go absolutely perfect to be in a position inside the end of this decade to be able to deploy that. Things could go absolutely perfect, but you also, you want to be realistic in your messaging, and that's what we are. We're really excited about it, but there's still more work to do on this project.
But realistically speaking, end of this decade sounds reasonable.
Yeah, a lot of things would have to go right. We would have to see the right price for the natural uranium. We would have to see the right price for the normal commercial LEU. We'd have to see a market evolve for the high assay, low enriched uranium. So there's a lot of ifs there. But if all of that started to form out, then we would be in a position to make a move into the enrichment space and be very happy to do that.
Well, it seems like you have two governments almost working for you. Like the Russian government is trying to do their best to make sure that the price of U3O8 goes up, and then the American government is working towards making HALEU more valuable. I see the time is pushing. It's lunch for you over there, if I'm not wrong. And I'm almost through all my questions. Just maybe a couple of short ones at the end. What would Cameco do at higher price? Like as the company makes more money, what are you going to be doing with that one? Like, would you be aiming to grow the dividend, doing buybacks, something else perhaps? Any other plans?
Great question. We think there are lots of opportunities in the front end of the nuclear fuel cycle. So obviously, as our contracting ramps up and then we get the cash flow and earnings that come from the homes that are built under a rising price scenario, that's an incredible turnaround in our financial numbers. Our margin expansion comes because we're running assets instead of keeping them in care and maintenance. It comes because we're producing more material rather than buying it. And all of that is margin growth for our owners. We would always look to invest first. So for example, with the growth that's in the front end of the nuclear fuel cycle, if we had compelling investment opportunities that made the kind of risk-adjusted returns that our owners would be expecting and built in that tail of future cash flow and earnings, we would look to that. If we didn't require all of the financial capacity to do that, then probably the next thing we would look at is what is our financial leverage situation? And that's always a target. We like to be investment grade. We navigate by our investment grade rating. We maintained an investment grade rating through a price cycle where on a cost adjusted basis, uranium has never been cheaper. So investment grade matters for us. So we would look at our leverage relative to a net debt to EBITDA target relative to an investment grade ambition. If the growth in EBITDA meant that the leverage was really reasonable and there were no concerns there, we would then say, if there isn't a good investment opportunity and leverage is where we want it, then really we're having a conversation about returning excess financial capacity to our owners. In which case we would look at a whole bunch of different things, wouldn't we? We would want to know what's the most effective way to do it. Is it through a normal course issuer bid, a special issuer bid on a share buyback? Is it through a dividend policy of growing the dividend with growth in the contract portfolio, for example? You can imagine that evaluation goes on constantly as we turn the business cycle and the business plan with this improving environment. But just happy to say we're having those conversations in a meaningful way now with the turnaround that we've seen in the business. But that's probably the right way for folks to think about our decision making on capital allocation.
But so you're basically giving me the geologist answer, saying it depends, because it does.
Absolutely it does. But I think what's useful is a framework for knowing how we would think about these kind of decisions, and that probably is an appropriate framework.
No, it is. I appreciate the overview there. What do you do with your cash sort of short term? Do you keep it in short term T-bills or something else? Interest rate seems attractive now.
Yeah, we are sitting on a lot of cash right now, but that's just because we're waiting for the closing of Westinghouse. And so when the Westinghouse deal closes, we will pay for our share of it, and there'll be some cash out the door for that, obviously. In the meantime, we've just have kept it in a super secure mandate, and thankfully, I mean, with the trouble we saw with the regional banks in the United States, for example, banks in Switzerland, it is important for us to be very conservative with managing that kind of cash balance, and we have been. The investment returns have exceeded our budget plans, obviously, with the change in interest rates. But look, our job is not to hang on to our owners' money in order to park it in a savings account and collect interest on it. So we'll complete this transaction. We'll return to more of a run rate cash balance. We're not looking to be the savings account of our owners. And then as we get the recovery in the uranium and the conversion segment, for example, and more cash flow comes in, then it triggers those capital allocation decisions that we were talking about.
No, you're not one to keep other people's money and not give it back. That's some government's job, without commenting on which one. Grant, this was great. You go on a lot of these podcasts and you do a lot of interviews. What is, maybe just to close it off here, what's something that nobody asks you, something that's not common knowledge in the industry, but you would like to talk about?
Well, that's a tough question because you've asked so many good questions that I think really have gotten to the heart of what the issue is. Let me turn it slightly differently, and I'll go back to your opening question. Another feature that's different this time, along with the market features that I talked about, is we just see a much greater investor awareness of how the uranium market actually works. I think that maybe in the past, there was too much of a commodity model brought to the uranium industry. And so then folks were disappointed when, you wouldn't have the immediate responses to events in the industry show up in the spot market like you do in other commodities. But we've seen over time an investor intelligence on, wait a second, this has a different market structure. It is an industry that isn't a spot industry. It really does pivot around where term contracting is. And that's how I assess the health of this industry and know where it's going. And it has a different industrial structure. It has a number of producers, some state-owned enterprises, some diversified mining companies for whom, uranium isn't a commercial endeavor. And so you've got to keep that supply in mind when you think about the primary supply stack. And then the commercial opportunities actually sit atop that. So we just see a greater awareness of the market structure, how producers need to be positioning for volume and timing. And we see greater awareness of the industrial structure in that a state-owned enterprise that produces uranium isn't going to make way for what looks like a great project out of the Athabasca Basin. I'm pretty sure in Uzbekistan, nobody cares about the feasibility studies of some projects in the Athabasca Basin. Yeah. They're not going to go, oh, well, we're going to turn down our production because there's potentially such a good project there. You have to think about the industrial structure and the role of that tier zero supply hitting the spot market. It has to be formulated as part of your longer term value creation strategy. We just see more investors right across the spectrum, far more fluent in how our market works than we've seen in past cycles. And that's great news.
I agree that it's great news. There's a lot of great news, a lot of good developments happening, and I'm very excited to be following along. And I'm very excited to have spoken to you. Thank you so much for investing your time with me, Grant. It was really great.
Certainly our pleasure, and look forward to doing it again, Antonio.
The pleasure is all mine. If anybody wants any information, I'm going to put some contact information on the screen right now, but it's basically Cameco.com. You cannot miss it. You have a great investor relation desk that is going to probably get to your questions. So Cameco.com, and Grant, thanks again.
Thank you.